And would you invest in Tesla?
No.
Okay.
Tesla has delivered explosive growth over the past years, but the real question investors should be asking is whether that growth can realistically continue into 2026. Can Elon Musk, the CEO of the company, make this possible? I'm not a financial expert, and this is not financial advice, but by looking at Tesla's financial data, we can get a reasonable idea of where the company stands and what kind of future it may realistically deliver. To evaluate Tesla's potential, we first need to look at total revenue. Revenue shows how much market the company has captured and whether the market is still expanding. At the beginning of this graph, Tesla generated around $4 billion in revenue, and over the following years, the number grew aggressively as the company expanded production, deliveries, and global presence. By the end of 2024, Tesla reported approximately $97 billion in total revenue, which represents one of the strongest revenue growth stories in the market. When we calculate the compound annual growth rate, Tesla achieved close to 70% annual revenue growth over nearly a decade, which is extremely rare. Nevertheless, revenue growth without earnings means less. So the next key metric we need to analyze is earnings per share, or EPS. In 2017, Tesla had a negative EPS of 0.79, meaning the company was losing money for shareholders. But starting around 2020, Tesla became consistently profitable. Earnings per share increased through 21, 22, and 23, showing that Tesla had reached a new stage of maturity. And then, in 2024, EPS dropped significantly compared to 2023, which raises concerns about whether profits can continue growing in a predictable way. To understand what happened, we need to look at margins. Tesla reported a gross margin of around 70 to 80% and a net income margin of roughly 7.3%. But when compared to the S&P 500 average growth of about 12%, Tesla's profitability appears relatively low for a company priced at such a premium. Now, let's look at Tesla's financial strength. Tesla had about $122 billion in total assets and roughly $48 billion in liabilities, which means the company can comfortably cover its debts and continue operating even in difficult conditions. The Musk's company also held around $16 billion in cash and $20 billion in short-term investments, giving the company significant flexibility for the future investments or strategic moves. One important point investors often overlook is capital expenditures, or CAPEX. Tesla spends massive amounts of money on factories, machinery, and infrastructure, and its capital expenditures actually exceed its net income, meaning all profits and more are being reinvested into sustained growth. This does not automatically make Tesla a bad company, but it does increase execution risk. Now, we get to the most important part of this video: the stock price. At around $450 per share, and with an EPS of about 2.04, Tesla trades at a price-to-earnings ratio well above 200 and closer to 300 using more recent data. A PE of 300 means that at current earnings levels, it will take roughly 300 years to justify today's stock price. For comparison, Alphabet trades at a PE of roughly 32, which highlights how extreme Tesla's valuation really is. For Tesla to justify its current valuation, the company will need extraordinary growth, near-perfection execution, and verifiable external conditions for many years. In my unexpert opinion, Tesla has become a gamble where we don't know now if the stock is worth of our money. Musk has a now proposal of getting Tesla stocks if he makes the price go high. To achieve this, he will need to take risks that we, the investors, should be worried. So the real question is simple. Is Tesla still a growth opportunity in 2026? Or is the market already pricing in an unrealistic future? Let me know what you think. And if you're already invested, how has it worked out for you? Have a good day, and always keep learning.